How's it going, friends and family? Welcome to another episode of Dividend Compounders with Cheese. In this episode, I'm going to be bridging the gap as to why the total performance of my portfolio is really low. And in the second half of the video, I'm going to be looking at software stocks that I want to put on my radar during this sell-off. And we're also going to be looking at the cybersecurity and fintech stocks as well. That sounds good with you? Let's go ahead and get into it. So I just uploaded a video onto the channel, episode 1, where I showed you my portfolio for the first time. Right, I revealed my holdings and everything. And the total return that you see on your screen right now, 44%, is inaccurate and it's way too low. So here's the first half of the video. Here's the reconciliation of what happened and what my actual performance is. So to backtrack, let's go back in time. I got into investing in the stock market in 2019 when I was pursuing my MBA, because at the time I was taking a bunch of classes related to how to be a good business leader, right? Like financial accounting, corporate finance, equity research, and the list goes on and on. So naturally, I got into the stock market because if I'm going to be learning about it in the classroom, why not put the academic theories to the test into reality? So like many others of you that are watching this video, I signed up for accounts on startup brokerages like M1 Finance, Robinhood, and Webull. I'm not gonna lie to you because of the sign-up offers back in the day. Well, fast forward a few years, I realized it was madness to have my capital spread across so many different platforms. It was getting a little chaotic. That's when I decided to close all of my accounts and consolidate it, all of it, into just one. To keep it simple, stupid. That's the advice that my first sergeant that gave me my first salute when I commissioned as an officer, he told me, KISS, keep it simple, stupid. The moment that you start trying to complicate things and convolute all of the different battlefield tactics, you lose, your men get lost in the sauce. Essentially, I was overcomplicating the process. So having said that, I decided to go with an old school brokerage because they still have human customer support based in the US. And for me, that's super important. I do not want to talk to an AI chatbot and to be able to de-escalate the issues that I might be having. So that happened in the summer of 2023. So the performance of the Dividend Compounders with Cheese portfolio, it only goes back that far. Right, because I consolidated everything into one portfolio during that timeline. Funny enough, soon after, that's when I started uploading videos onto the channel. So I guess the cool thing is the performance of the portfolio is directly tied to the history of the channel. So at least we got that going for us. Nonetheless, if you're keeping track, my performance and CAGR from the other accounts, well, unfortunately, they were lost in the transfer. Since many of the holdings were in fractional shares, I don't do fractional shares anymore, and I sold them to just move it as cash into my brokerage account to keep things simple, because some of them, they were like, oh, we can't do this, or oh, this is going to be an issue. So can you imagine if we added 4 years of gains to the portfolio? It would be much higher, right? It doesn't take a rocket scientist. And that's why I was like, after I uploaded the video, I took a look at what I was seeing on the screen, and I was like, wait, hold on. 44% total return? That don't sound right. And so I started investigating, and that's when I put all the pieces together, and that's when it gets worse. There was also a sync error in Snowball Analytics, which is the platform that you're viewing the portfolio right now. And what frustrates me even more is that Snowball never recorded the profits and gains from when I sold out of NVIDIA, AMD, Microsoft, Oshkosh Corporation, 3M, and Marvell. Meaning, even after I sold out of the positions with green, Snowball did not add it to the total return of the portfolio. For some strange reason, it only included when I sold out of Google and Apple. Those gains are accounted for, but the other ones, they're missing. And so after adding it back in manually, the actual total return of the portfolio since the summer of 2023 is 72%. Please forgive me if I round up. The other day, I'm serious, I got a comment from someone saying I'm a filthy liar because I said 71% and I rounded down. He's like, no, it's 71.9. I can't trust anything that you're saying. And it's like, bro, first calm down. It's the same thing at the end of the day. 71, 71.9, whatever. As a matter of fact, I should round it up and go 72%. So that's the real math that has happened in the past 2.5 years. And to verify the performance of the Dividend Compounders with Cheese portfolio, on my brokerage account, the breakdown for the 3 years, the total return is 71.9%. But it's very important to keep in mind, it says 3 years, but it's actually only 2.5 years of data, because I transferred everything in the summer of 2023. If we were to bake in 6 more months of data, I would assume that the total return would be a lot higher. But I can't say for sure, because when I consolidated my brokerage accounts, the cost basis for the shares became all wonky, but it also didn't take into account the gains that I made when I transferred over the cash when I sold out of the position. So, but since the summer of 2023, 71.9%, that's not bad. Right? And if we scroll up and take a look at it just 1 year out, 33.2%. In comparison, the S&P 500, the benchmark that I'm trying to compare my performance to, is 16.9%. And so even though on surface level I come across like an idiot, immature, and I'm not really polished with the way that I say my words, how I articulate my thoughts, not bad, right? To 2x the S&P 500. That's why I do the portfolio roast, where I review your portfolios. On the other hand, I don't want to come across as conceited and as arrogant. So bringing myself back down to earth, my biggest regret in all of this is not keeping track of my own holdings and performance on a Google Sheet or Excel as a third-party method. That way we could all see the performance since the very beginning. I really wish I would have done that, right? I think like most investors, I just trusted the in-house data from the startup brokerages, and it never occurred to me to record it, just for my own record-keeping sakes. But I think when you break it down since 2019 or whatever, I think the CAGR shakes out to about 20 to 21% year over year. To be honest with you, I don't think that's too bad. Now, obviously, I could do passive investing and just put my money into an S&P 500 fund, be happy with a 10 to 12% ROI year over year, but doing it my way, 20 to 21%, not too bad, right? And by the way, keep asking questions about my portfolio, the strategy, and everything, because I'm reading them, and I'm going to integrate it into future uploads so I can systematically answer all of the questions that you have. You're doing a good job, by the way. Some of your questions will be answered in episode 7. For others, it will be like episode 9. But they will be answered. And before we transition to the next topic, I wanted to get on my soapbox and say this, okay? From the bottom of my heart, thank you so much for the kindness that you have shown me. For the past 3 months, past 9 months, or however long you've been with me on this YouTube channel, I am so grateful for all of it, for the encouraging comments, for supporting the channel on Patreon, for helping out with my new baby through PayPal and the Amazon gift wish list. I should do this more often and give you guys public praise, because between you and me, I'm going to be thinking about it for the rest of my life. A bunch of strangers on the internet decided this guy is not half bad. And you know what? His story resonates with me, or his methodology, I like it, or his approach to stocks, whatever it is, whatever the reason is, you've decided to stick around and to support the channel. And so to be honest with you, y'all are the reason why I'm able to keep grinding on YouTube. There are days when I want to just pack it up and quit. Cold turkey, pivot into a strategy role in corporate America, make like 200 grand, and be a happy camper, right? But the fact that I'm willing to stick it out speaks volumes to how much you guys mean to me. Your feedback and the community that we are building together makes all of it worth it. Don't get me wrong. In the beginning of this channel's history, dude, I was lucky to clear $20 a month. And then it went up to $80, and then it went up to $150. Now in a good month, now we're seeing $500, $600. On a slow month, we're seeing $200. But the fact that it's progressively growing, that's why I do not want to throw away this dream. I'm going to keep chasing it. I'm a reasonable guy. I will throw in the towel if we start to decline, if there's undeniable objective metrics that say I'm losing steam and it's not sustainable. Yes, I will quit. But for the time being, dude, the snowball is getting bigger and bigger, right? The snowball just keeps compounding. And patience, hard work, grit, and resilience pays off. And so call me delusional, but I think given another year or so, the channel should be financially successful, or at least I hope it is. Now, having said that, I love you guys, okay? If you haven't heard it from anyone else lately, there's someone out here that genuinely cares about you and wants the best for you. And I mean it. If you're getting married soon, if you're expecting a child, send your little link my way. I will contribute a quarter pounder with cheese or something like that, right? But having said that, take a look at your screen right now. Very recently, I asked the channel community, a day ago, 460 of you participated. I was like, hey, nearly all of the fintech and SaaS stocks are dropping to 5-year or 10-year low valuations. This is nuts. What say you? 9% of you said, that's why I never bothered. Value investing all the way, because value investors, they don't really chase hype and trends. They don't bother investing into NVIDIA, Palantir, and AMD, okay? Just to explain the logic there. 58% said, I'm buying the dip. 11% said 2026 is the year of dividends, being better than growth stocks. Risk is not sexy. There is some merit to that. If you take a look at SCHD's performance year to date, they're probably one of the best performers in 2026. As crazy as that sounds, because in 2025, people, I will not forget. Okay, SCHD might forgive you, but I will not forget how many of you guys jumped ship and said, bye SCHD, you suck. But something weird about me is I have this loyal personality trait where once I pick something on the menu at a restaurant, or once I become a fan of a sports team like Tottenham, regardless of how crappy their season's going, I stay committed and I'm loyal to the end. So with SCHD, I love their methodology of their holdings and the consistency of their dividend growth rate. So I never jumped ship. I never lost faith in them. So I'm happy to see them bounce back. And now people are going to bandwagon back into SCHD, even though you turned your backs on them. But anyways, the fourth option was I will buy once it drops even more. Sorry, everyone else. So for the second half of the video, I'm going to straight up tell you I already bought into 2 SaaS or software as a service stocks, which will be featured in the next episode. However, the folks on Patreon, you already know which 2 stocks I'm talking about. So having said that, I wanted to analyze the other stocks to see if I'm better off with adding a third one that's in fintech, cybersecurity, or software before the next episode drops. So that's what we're gonna do together right now. Now, before we dive deep into the stocks, I'm gonna whip out my glasses because I think that'll add at least 1 IQ point to my appearance, right? So, doesn't matter. If you could just get a dart and throw it onto a board of all the SaaS stocks, and they're going to be near their 1-year low unless your name is Uber and Shopify. But as I scroll down right here, before I do, what's the average PE ratio at 33.8 across the board? Wow, Uber in the top 10 is the only one that's in the green for the past 1 year. And I know they just reported their earnings. After I finish filming this video, I'm going to read up on it because Uber is a company that I think is fundamentally undervalued. They do have some headwinds in robo-taxis like Amazon ZooX, Google's Waymo, and Tesla's FSD for sure. But like I said in the weekly earnings call, that type of threat is going to take at least 5 to 10 years for Uber to be smacked hard. For the time being, I think them utilizing 1099 employees to drive out of their own vehicles to deliver food or people, I still think that's going to be the main way to go. Now, obviously, I did not tune into the earnings call, so I don't know how things have been going for them for the past 90 days. But this is a company that's on my radar. But I'll be completely honest with you, not at, oh my gosh, what in the hemoglobin was that year to date? Negative 9.5%, golly. So I'm going to say it right now, at the current valuations, I'm not interested. But having said that, if they keep falling, they do have my attention, right? So if they keep falling, that is something that I do want to circle back and look into closer. But let's see. We got SAP, Salesforce, Shopify. I mean, Shopify is really resilient because not only are they helping small business owners open up and develop a website, but they're also integrating payments into their website. So payment processing. That's a crazy, fully integrated ecosystem. I'm not invested into Shopify, but I love it, right? It's such a simple business model, but prints cash. Got into it. Dude, at this point into it, they've got my attention, right? $445 a share, whereas in the past 1 year, they reached the high of $800. They're almost 46% into the red from their all-time highs. That is absolutely ridiculous. And I'm not trying to say, oh, just because they've fallen in their price valuation, now they're cheap. But the numbers that they're executing, I mean, we can see it right there on the high level. Their gross sales, 17% year over year, and their bottom line per share, 41% year over year, and their forward trading multiple being an 18.7. I'm gonna tell you this right now. After I look into Uber, Intuit's also another company that I really want to investigate. Now, obviously, they're under threat right now from vibe coding because they're in the business of selling tax software like QuickBooks, TurboTax, but also, is it MailChimp? Something like that, right? The email marketing company and payroll software. They are under threat, but I feel like it's also overblown, guys, right? As you look at the financials and the fundamentals, let me switch this over to S&P Global. You take a look at their financials and fundamentals, I mean, this is solid. So when I see them falling this hard in their valuation for a company that's excelling in their operations, I'm interested, especially with a dividend growth rate of 15%. I'm not trying to be racist, but don't be surprised if they become a part of the Dividend Compounders with Cheese family in the future, right? I think what I see is juicy. So I'm going to be following up on that in Uber. So out of the SaaS sell-off, I definitely think Intuit is high on my radar. Same with Salesforce. Same with Adobe. Dude, at this point, it's almost ridiculous, right? If we zoom out 5 years ago, back in 2024, this is a company that was easily $630, $650 a share. My goodness, have they fallen. 36% into the red year to date, 20% in the red. Forward trading multiple 11.2. Bottom line per share growth is 35%. Gross sales is 10%. I think too many people associate Adobe with just their creative suite, Premiere Pro, Photoshop, the stuff that you edit photos and videos with, but they're also in the business of Adobe Acrobat, right? The PDF, and they're also venturing into the cloud. I think it really depends, right? Some people, you think that Adobe is going to disappear in light of AI doing all of the heavy lifting and hard work. For others, we realize that Adobe is integrating AI into their features and settings. Me, personally, I like Adobe. Having said that, I don't have enough conviction to jump into them. I think out of the SaaS software stock sell-off, I wouldn't categorize them as tier 1. I know, what I just said right there might offend some people. I think they're tier 2. What do I mean by tier 1, tier 2, tier 3? I think tier 1 are companies where their business model is robust, their economic moat is durable, and their operations are going to be resilient in the face of AI. AI is not going to make them obsolete. So when I think about tier 1, I genuinely think that's Microsoft. I think it also includes blank. You're going to have to wait for the next episode. But tier 2 are the ones where I do think they have a juicy business model, but I'm also on the fence on whether or not they're going to be resilient in light of AI, knowing full well people might hate their business model or their subscription payment method. And because of that, the consumer base is willing to jump ship as soon as there's another alternative. Something like that would be tier 2. Tier 3 are the software stocks where I genuinely think they're doomed. They are not going to thrive once vibe coding, Anthropic, Claude, and all these other AI software that we don't even know about because they're in stealth funding right now from venture capital firms. I think they're going to replicate and pump out a software platform that'll replace them overnight, easily. So not something that I would personally want to invest into. Adobe, tier 2. However, if you're invested into them, I can't fault you. I do think they're high quality and they do have an economic moat because I think they're best in class when it comes to the creative suite. But Canva, Photar, Figma, and generative AI from OpenAI, Google's Gemini, and Microsoft's Copilot is a real threat, and it's growing by the day. Having said that, we got Snowflake. To be honest with you, I looked into Snowflake in 2020 when they IPO'd, and I didn't understand their business model, so I never jumped in. You fast forward 6 years later, I still don't understand their business model. But what I do understand is that their financials are absolutely juicy and ridiculous, and I think it's a company that Berkshire Hathaway jumped into at one point, Warren Buffett. I could be wrong, but it was one of the big super investors. They did jump into it as well. And if you take a look at what's happening to them, it's also almost raises this eyebrow to say, is this a buying opportunity? So Snowflake is definitely a company that I want to circle back on because you take a look at their fundamentals and financials. I mean, it looks pretty darn good, right? All I know is that they're in the business of something related to the cloud. I don't know exactly what they do with the cloud, if that makes sense. So if I can understand their business model and I feel bullish about it, then I can categorize them. But honestly, I don't know if they're tier 1 or tier 3, right? So definitely one that I want to look into as well. If you know what Snowflake does, could you please do me a solid and leave it in the comment section? We also have Workday, which to me, I think their ecosystem and their platform is very similar to Salesforce. I think it's going to be sticky, high switching costs, and they're in the business of data management. So when I think about vibe coding and AI disrupting them, I think it's the exact opposite. I think AI is going to be augmented and boost their productivity and their sales for them to upsell extra features. So Workday and Salesforce, I think they're tier 1. And then we have Strategy. They're in the business of accruing Bitcoin. And for a lack of better words, it's a leveraged bet on Bitcoin. Not a company that I would personally want to buy into, but if you buy into them, I don't fault you. I think it's very high risk, but on the flip side of that, it also comes with high reward, right? I don't have that kind of risk tolerance or risk profile to be able to go into Strategy. We also have Roper Technologies. They're in the business of developing software for the unsexy industries, right? Like the truckers, for government, municipalities, for school districts. I actually really like them. But what I do not like, and they also make software for the water utility companies to measure water production and the filtration process. As you take a look at them, negative 37% into the red in the past 1 year, their forward trading multiple is 16.7. One thing that I want to call out is if we jump on over to the ratios tab and you take a look at their forward trading multiple, it's usually sitting at a 22, 26, a 30, 26, a 16.7. Valuation-wise, it's never been lower. So Roper, gosh, I know the government, I tuned into their earnings the other day. They just reported, and they're losing revenue from their government lines of business. But I feel like that's a temporary speed bump. I don't think it's a permanent thing, right? And for a company that serves the underserved communities in terms of when we think about Google, Microsoft, or NVIDIA, AMD, they're making their products for the hyperscalers, for the sexy industries. Roper, they're making their business products for the small businesses, the medium businesses, the ones that are often neglected. So when I think about that demographic and the TAM, the total addressable market, I like. What I don't like is I don't think there's any signs of the bottom having been reached. So definitely do not know when I want to jump in with this one. I would argue they're tier 1.5. They're somewhere in between 1 and a 2. High quality, they're at a 5-year low. I mean, that's ridiculous, right? A company that used to be, this is so fun to say, right? A company that used to be 588, now 359, and the only thing that changed was the speculation and the narrative that vibe coding is going to disrupt and make them obsolete. Do you know why it's called vibe coding? It's because you literally give a prompt, a vibe, for the AI to generate that software for you. Like, I want this software to be able to match me with other 6-foot guys with small feet. You know what I'm saying? They'll create a software platform that allows you to meet other 6-foot guys that have small feet. But the thing is, I could be wrong, but you can't vibe code your way into integrating that software, managing proprietary data, to do ongoing support, to do ongoing software updates, to do the hardware installations, and to have your consultants to go over there to teach the people how to use it. And that's why I think the vibe coding sell-off is so overblown. Now, obviously, here, maybe let's talk about a tier 3 software company that I think is going to be absolutely disrupted and almost become extinct from vibe coding. And then maybe we can go from there, right? Let me see if there's one that kind of sticks out to me. I know this is going to be an unpopular opinion, and I apologize beforehand. But the first software stock that I would categorize into tier 3, that they're seriously facing an existential crisis with generative AI and vibe coding, is Duolingo. What they're doing, they're in the business of creating apps to learn a language, music, chess, or mathematics, right? You can vibe code a software or an app to do the exact same thing Duolingo is doing. There is no economic moat. Yes, they have built up a community, but there's no barriers to entry. You could vibe code another software that does the exact same thing that Duolingo does, gamifying the learning experience, and make it just as addictive. So when I think about Duolingo, I know this is going to be really unpopular because their numbers are juicy and it's cheesy. If you're invested into them, I get it. It looks flawless, especially their cash flow, juicy. Historically, it looks juicy. But vibe coding and generative AI, guys, I don't feel confident about Duolingo. Me personally, I would not want to go near this stock. They do not have an economic moat. Because when you think about Microsoft, right, the commercial license to enterprise customers and then having your ecosystem of apps work seamlessly with one another, that is an economic moat. And that's a resilient business model in face of this AI threat. With Duolingo, there is none of that. Any intruder, any enemy, any peer, any rival, Google could announce their own variety and flavor of a Duolingo tomorrow, and Duolingo would be doomed. Microsoft could do it. There's no economic moat. And that's why when it comes to these software stocks, I think the first thing that I want to consider is, do they have an economic moat or not? And the second thing is, will their business model be resilient in the face of this AI threat? Not all of them will survive. I'm saying it right now. I'm not trying to be a genie in a bottle and saying I know what the future is going to look like, but Duolingo tier 3. I'm so freaking sorry, guys. And some of these other ones, let's see. Asana is another one. Dude, I really like them. I personally use it to stay organized as a YouTuber. It's a project management dashboard platform. Dude, they are so doomed by AI, I definitely think. And besides, they have so much competition. There's Trello, Monday.com, Microsoft Teams, and the list goes on and on. They do not have an economic moat. Yes, their financials are juicy, but gosh, I don't think there's a compelling reason for a customer to pick Asana over the competition. There's no economic moat with Asana. So this is one of the software stocks that I personally will not go near. But scrolling back up, one of the software companies that I wanted to address head on is ServiceNow. They do have my attention, but the valuation I think is still far too fat. Because some of these other high quality compounders, they're forward trading multiples like a 15, 16, right? I think with ServiceNow, it's still a little too expensive, especially for the numbers that they're pulling off. I mean, don't get me wrong, it looks great. But everyone in this category is executing numbers that look great. It's not different and unique to just them, right? And I just don't know if AI is going to be able to replace them, right? Because they're in the business of helping companies to organize and to automate IT tickets, to onboard staff, and to de-escalate customer service requests. I do like what they're doing, but guys, I do not know if they have a business that is resilient in the face of AI. I feel like AI could just replace what it is that they do, but it's also stemming from the issue that I truly don't understand their business model. Like on a high level, I get what they do, but I don't understand them to the same detail like Microsoft or Adobe or Salesforce. So ServiceNow is also another company that I truly want to do a deeper dive and look into, because I think the numbers paint a pretty compelling story, especially with their free cash flow margin being 34%. Dude, that is bonkers. That almost makes me want to see their ROIC. 17.8%. Pretty good. I mean, it's in a downward trend since 2024, but it's still pretty respectable. Do they pay a dividend? No dividend. $111 a share. If you know what ServiceNow is, like if you have experience working with them, if you're an IT manager in your organization, please put me on. I want to understand. This is one that I don't get, but I know it's really popular. Now, having said that, let's go ahead and transition and look at the cybersecurity stocks that are also going through this huge sell-off. I guess, is there no category that's just cybersecurity? I think there's one way to do it. Let's look up the ETF hack, amplify cybersecurity ETF, and go to the holdings tab, and we can take a look at, there's 25 holdings, and we can take a look at it this way. Broadcom and Cisco, I think they're in the hardware aspect of cybersecurity. But I guess the first one would be Palo Alto, and there's also Fortinet. These are both software-based cybersecurity. There's CrowdStrike. These three right here would be the big ones that I want to consider. But also Rubrik, which is the one that I pulled up initially. Zscaler, I also understand is cybersecurity. With this one, I think it was really famous for being pumped by Congress folks. Past 1 year, negative 8%. My gosh, they're falling. Golly, past 5 years, 164. So in the grand scheme of things, it's still pretty good. But what in the hemoglobin is that? Bottom line per share decreased by 59%. That means something happened on an accounting basis that ruined stuff. So what was that? $1.58. Let me take a look at it as a litmus test, the free cash flow per share, to see if things are still good. Things are still good. $5.20 is their free cash flow per share. So it was just an accounting one-off, cooking the books, right? Taking a hit on a loss or whatever it is. But just like with how Peter Lynch and Warren Buffett always advocates to stay in your circle of competence, I truly do not understand what the heck Palo Alto does. All I understand is that they help protect an enterprise's data. I don't know what makes them any different from the competition. So that's homework that I'm assigning to myself because I truly don't know who the winner is going to be in the cybersecurity space. But based on numbers alone, it looks like Palo Alto should be up there. I'm clicking back until we can get to the portfolio holdings. There's Fortinet. Ooh, my gosh, they've been in a downward trend since August. I'm assuming they reported their earnings and then crashed pretty hard. Trading multiple, kind of fat, 28 as their forward. Growth in the top and the bottom line looks pretty darn good. Do they pay a dividend? No freaking dividend. Why don't the cybersecurity players pay a dividend? Cash flow looks pretty good. What's their debt situation? $3 billion of cash on the books. Total debt, $1 billion. Flush in cash. They have $2 billion of cash left over. I would argue that's pretty good. I mean, wouldn't you? I understand who the main players are. Palo Alto, Fortinet, CrowdStrike, and Rubrik, Zscaler. I just don't know what makes one better than the other and who's going to thrive. I would imagine they should all be thriving in that they target one element of security or defense, unless they're all doing the exact same thing, in which case that complicates the issue in hand, and I truly don't know. But from what I do understand, Rubrik, they're not profitable, but I think they have the most hype and the potential based on my understanding, because their business model is predicated upon the premise that you are going to be hacked. It's not a matter of if, it's a matter of you are going to be hacked. So they're in the business of securing your data when you do get hacked. So making sure that when the person hacks into your server, they can't access your client's details, their passwords, and all of their sensitive information. When I think about that, I'm like, I love it. That serves a great need because tuning into earnings calls for the past 2 to 3 years, believe it or not, a lot of the S&P 500 companies, they get hacked into, and then these hackers, they request like $500 million or $1 billion. Otherwise, we're going to leak all of your data. And guess what happens? These big conglomerate blue chip companies, they pay up. So you best believe that an S&P 500 company, they are going to pay money to one of these cybersecurity businesses in order to stay protected. Because not only do you get bad PR, you're also going to lose trust from your customer base, and you're going to take a bigger hit from the threat, from the blackmail. Whereas if you just pay a subscription cost to stay protected, you can circumnavigate all of that. You don't have to deal with any of it. That's why I'm also looking into cybersecurity. The fact that they're also selling off because of generative AI and vibe coding, I'm like, bruh. They're in the business of protecting data. Firewalls. Even if AI replicates that, it makes it no different from what they can offer. It's like Rubrik and Palo Alto, what they're doing, and what AI made is the exact same thing. So why not go with the verifiable, the tried and true, the battle-tested one, rather than something that an AI coded itself, right? So when I think about the overblown, the emotional selling in all these sectors, I'm thinking there's opportunity. Obviously not all of them, but Rubrik, it does have my attention, but it goes against the grain of my value system in that even though their top line is pretty good, I mean, 2024, what in the hemoglobin was that, a 4% increase? But then since then, it's just been, hold on, I want to verify that. Yes, it's aggressively scaling since I want to say Q2 of 2024, it's just been increasing aggressively. So that's exactly what I want to see. But what I do not want to see, friends and family, that makes me uncomfortable is that they're unprofitable, right? On an accounting basis, something's going on where they're not showing profits. But as a litmus test, we go to the free cash flow because the cash flow statement shows us what's the cash being generated from the operations. You can't cook the books with the cash flow statement. I mean, I guess you could with CapEx, stock-based compensation, and all that other stuff. But with the income statement, the P&L, you can actually cook the books by doing accounting write-offs, by taking losses on paper, by doing one-time tax events that help you or hurt you, right? You can artificially engineer your EPS to be better or lower. With the free cash flow, you cannot do that. So with the free cash flow per share, it's positive. So they've been generating cash from their operations since January of 2025, 20 cents, and now it's $1.33. So on paper, they're still printing cash. And just as a litmus test, because they don't have a PE ratio because of a negative EPS, let's go ahead and do some napkin math. They're about what, like 51.87? What was the low that they reached today? 48.58. So if we just go in the middle and say 49.50, and we divide it by their free cash flow per share, which was like $1.33, their price, the free cash flow ratio is like a 37.2. It's a proxy for the PE ratio. So I think they're still a little too expensive in the grand scheme of things, right? Especially in comparison to their peers of like Palo Alto, where it was like a 26, 28. They're at a 37. So even though I am interested in Rubrik, I would have to dive deeper to see, is it a safer alternative to CrowdStrike or to Palo Alto? I think they're all high quality. It's just, this is outside of my comfort zone. I do not understand what makes them different from one another. Like Rubrik, I understand, I guess to a certain degree, but like Zscaler, I don't know, right? Fastly, I do know they're in the business of securing websites. Let's take a look at them. Oh my gosh, $8.31. I remember during the pandemic, they were like $50 or something like that. Yeah, during the pandemic, they were a pretty solid investment, but since then, they've just been falling. I'm guessing they're losing the battle to Cloudflare, ticker symbol NET. But, I mean, their numbers are still... Oh, I see what it is. They've never been profitable on paper. So I guess that's what's holding them back. What about cash flow-wise? Because cybersecurity, I imagine their overhead costs are really low. They're not in the business of building factories or manufacturing cars, right? So if you're free cash flow negative as a cybersecurity company, that's a valid concern and a red flag, right? Nah, they're free cash flow positive. But I feel like out of this entire category, I want to stick to the ones that I recognize and do some research to see who the true winners are. Like Sentinel-1, I also heard about. Rubrik, Zscaler, there's Cloudflare. They're the ones that are just eating up the market share against Fastly, I'm assuming. CrowdStrike, Fortnite. I don't know who the winner is here. But let's go ahead and jump on over to the last category, which is the fintech space. They're also getting absolutely destroyed. But I'm going to go ahead and stop myself before we go any further. I'm feeling a little dizzy. I've been filming all day long. I'm getting kind of tired, I'll be honest with you. So with the fintech ones, I don't think we're going to research together. I know the ones that I wanted to look into include XYZ, Pfizer, PayPal, Shift4, Toast, Sezzle, Klarna, Affirm. I was going to look into all of that, but guys, I'm dizzy. I think I need to eat lunch and just call it a day right here. So having said that, please put me on when it comes to the cybersecurity stocks. Like if you have knowledge or firsthand experience with, I don't know, Fortnite, CrowdStrike or whatever, please put me on. Let me know what the differentiators are or the industry breakdown. I would appreciate it a lot. Having said that, dang dude, I'm so dizzy. I love you guys. Stay safe. Good luck in the stock market and I'll talk to you next time.